The Department of Trade and Industry held its inaugural economy policy dialogue in Sandton yesterday evening to address the possible effects of the Eurozone crisis on South Africa. Economists, ministers and academics engaged in a panel discussion around how South Africa could weather future economic storms. Tumisho Maganyele reports.
A slight majority win in favour of the Greek bailout over the weekend saw a series of events play out on the emerging market stage, including increased investor risk appetite and a firmer rand.
So Greece reminds us that Europe is continuing to struggle in terms of reconciling national politics with regional economics. But in the grand scheme of Europe's prognosis, they're going to linger in recession through 2012 and quite possibly in 2013. In other words, I anticipate that quite possibly for the next 2, maybe even 3 years, South Africa will struggle to generate GDP growth in excess of 3%. But more importantly, whatever growth South Africa does generate is likely to have very shallow job creation. And of course, that poses a variety of political risks.
What started out as a systematic banking crisis has now morphed into an excess of sovereign debt. And while South Africa is increasing its trade links with other African countries and emerging markets like India and China, Europe is still its main manufacturing trading partner, with exports to the region accounting for around 27%. This means that the country is still vulnerable to what is happening in the Eurozone and could feel the impact of the debt crisis through its trade channels. On the back of a deteriorating trade balance, South Africa's current account deficit widened to 9.9 billion rand in April, compared to the 5.5 billion deficit recorded in March.
The overall bulk of our exports, especially manufactured and agricultural fishing exports, is to the European Union. So thousands of jobs are tied up to exporting to the European Union. So a potential slowdown or a crisis could have devastating impacts on the South African economy. And as we saw what happened in 2008, 2009, when the world went into recession, we lost 1 million jobs. We have to start diversifying our trade, especially to Asia, to the continent. Africa is our fastest growing market. We have to diversify our exports, find new markets.
Another contagion effect of the Eurozone crisis on South Africa is the fall in commodity prices, which has eroded profits and fueled unemployment in the mining sector.
It's how badly mining has been doing in the last, say, 10 years. And this is very odd because in most mining countries, like South Africa, think of Brazil or Chile or Russia or Indonesia, in most other countries that had a strong mining sector, because of the commodity price boom of mining, output has grown massively. While in China, mining output grew by 20%, in Chile by 12%, in South Africa it actually declined by 1 or 2%. So there is a big issue there.
The global economy has seen 120 episodes of recessionary cycles over the past 50 years, and stimulating economic growth through measures such as sound fiscal policy as well as rapid and sustainable job creation are South Africa's best defense against future global economic shocks. Tumisho, Maganyele, Johannesburg.